Hello students. So in today's lecture now we will be studying up with issue of shares for consideration other than cash. In the last two lectures you have already covered with issue of shares for cash along with its practical questions. Now what we shall be studying is issue of shares for consideration other than cash. So I discussed this with you earlier also. Other than cash means what? You buy any asset or you take over any business which has its assets also and liabilities also, but in return of that assets and liabilities which you acquire, what you give them is your own shares. So you are giving shares, but what are you getting in return? Assets or assets and liabilities, which is consideration other than cash. Now what entries will be passed? Understand it. First entry will be for taking over the business or assets and liabilities. So for taking over assets and liabilities, and if you purchase only assets, then only assets will come. So for taking over assets and liabilities, all of you must be writing it, and all of you ideally write this in the summary. In the summary means in the beginning of your chapters pages, and maintain a summary for all the journal entries and important points at one place so that it is available as handy reference during your exams. In the beginning of the chapter, every time leave 5 to 6 pages blank, and there you write whatever entries and important points come across throughout the chapter. So ideally in the beginning where you have finished with issue of shares at premium, after that you note down these entries. Now assets of the other company or business becomes our assets. They have debit balance. So to bring them in our books, assets account debit. Same way, liabilities of some other business become our liabilities. So to bring them in our books, we will write to liabilities account. They have credit balance. So to bring the liabilities in our books, we will write to liabilities account. And generally, the difference amount assets minus liability net assets is payable to the seller. Seller is called the vendor. So vendor is the giver credit, the giver to vendor account. This is the entry to be passed for taking over the assets and liabilities. I repeat, assets become our assets. They have debit balance. To bring in our books, assets account debit. Liabilities have credit balance. To bring liabilities in our book to liabilities account. And difference amount assets minus liability is what is payable to the vendor. So to vendor account. To vendor account we will always record with the purchase price. Okay, purchase price or purchase consideration what we are supposed to pay. Now here one more thing is possible. Suppose you take assets of 10 lakhs, liabilities of 4 lakhs, then you are supposed to pay 6 lakhs. Okay, 10 lakhs minus 4 lakhs. If you pay exactly 6 lakhs, well and good, the entry will remain same. But suppose you take assets of 10 lakhs minus liability of 4 lakhs comes to 6 lakhs, but you make a payment of 7 lakhs. You are getting 6 lakhs, but you make a payment of 7 lakhs. Now how much excess you are paying? 1 lakh. Why you are paying 1 lakh more? Because of the reputation of other business. So this you will debit to goodwill account. Means if the purchase price paid, which is 7 lakhs, I repeat, if the purchase price paid, which is 7 lakhs, is more than the net assets acquired, which is 6 lakhs, then excess amount of 1 lakh we will debit to goodwill account. So entry would become assets account debit 10 lakhs, goodwill account debit 1 lakh, to liabilities 4 lakhs, and to vendor account with the purchase price of 7 lakhs. So it will match 11 in debit and credit. Okay, I repeat, asset debit 10 lakhs. Further you will debit goodwill of 1 lakh, liabilities you will credit 4 lakh, and vendor account will credit with the purchase price of 7 lakhs. So goodwill will come. Now last situation, if You acquire assets of 10 lakh, liabilities of 4 lakh, you are supposed to pay 6 lakhs, but you pay 5 lakhs. You don't pay 6 lakhs, you pay 5 lakhs. Now you are paying 1 lakh rupees less. 1 lakh rupees what less you are paying is your capital profit. Being a capital profit, it will be transferred to capital reserve. Okay, it's one-time profit. It's a capital profit. So that amount will be transferred to capital reserve. Means in this situation, assets you will debit with 10 lakhs. Liability you will credit with 4 lakh. Vendor you will credit with only 5 lakhs. Here the vendor is to be credited with the purchase price of 5 lakhs. What extra you will credit is capital reserve of 1 lakh. So 3 situations are possible. Vendor we have to credit with purchase price. If we are paying net assets value only, then the entry will simply remain as it is. Asset account debit to liability to vendor. But what we are paying the purchase price, like 7 lakhs. If it is more than the net assets acquired, then excess amount you will debit to goodwill account. And third situation, if the purchase price we are paying less than the net assets, then it is our capital profit and that you will credit to capital reserve account. Now, shortcut. Actual concept is clear. Now one trick to remember the things. Okay, one trick to remember the things. This all you don't have to write. There is an easier approach to the same. What is that easier approach to the same? Understand it. You just remember one shortcut trick, that is, you will record this entry leaving one line in between. Means after assets you leave one line, then you credit liabilities and vendor account, and difference amount whatever remains, you have left one line in between. So in your journal entry, difference amount whatever remains, if it remains in debit side, then you write it as goodwill. If it remains in credit side, then you write it as capital reserve. So that one line will serve the purpose of both, which you leave in between. This is a very easy method. No calculations and workings are required here. Simply, you leave one line in between of assets and liabilities, and after passing the entry and recording vendor with purchase price, if any balancing amount remains in debit column, write it as goodwill. Credit column, write it as capital reserve. Okay, so like we did, asset debit 10 lakh, liabilities credit 4 lakhs. Now, if vendor you are crediting with 7 lakhs, then credit will be 7 lakhs, debit is 10 lakhs, so balancing amount 1 lakh will remain in debit column, write it as goodwill. If you write asset 10 lakh, liabilities 4 lakh, vendor 5 lakhs, then you credit 4 and 5, 9 lakhs. 1 lakh will remain in credit side, that you write capital reserve account. So there is a shortcut trick you can remember. Then you pass the entry as it is. Asset account debit, leave one line, 2 liabilities, 2 vendor, vendor with purchase price. After passing this entry, if any amount remains in debit column, write it as goodwill. Credit column, write it as capital reserve. Okay. Now second entry. After taking over assets and liabilities, we are supposed to issue the shares. So for issue of shares, what entry will be passed? Now, when we issue the shares, then shares can be issued at par or premium or even discount. Here the shares can be issued at par, premium or even discount. Okay. So if they are issued at par, then the entry would be vendor is the receiver, debit the receiver, vendor account debit, shares goes out, credit what goes out, you directly transfer it to share capital account. Here there are no installments like application, allotment, etc. Straight away entire amount will go to share capital account. if you issue the shares at premium. Okay, if you issue the shares at premium, then vendor is the receiver, debit the receiver, vendor account debit. Shares goes out, credit what goes out to share capital account. And as we studied in the earlier lectures, security premium is a capital profit one-time gain. Credit the incomes and gains. So you will credit that premium amount to security premium account. Okay, premiums amount will credit to which account? Security premium account. And here you can also have the shares issued at discount. As per the company law, the shares which are issued for cash, the last situation what we studied, they have to be issued either at par or premium only. But consideration other than cash, the shares can even be issued at discount. So again, vendor is the receiver, debit the receiver, vendor account debit. Now discount is our loss. Debit all expenses and losses. So share discount account debit with the amount of discount. Okay, share discount account debit with the amount of discount, and to share capital account with the total value. So three things are possible. The shares may be issued at par or premium or discount. If they are issued at par, vendor account debit to share capital. If they are issued at premium, vendor account debit to share capital account to security premium account. If they are issued at discount, vendor account debit, share discount account debit to share capital. Now, in all of these, before you pass the entries, you will be first required to find the number of shares to be issued. Before you pass the entries, you will be required to find number of shares to be issued. And how will you find that number of shares to be issued? Purchase price, that is the amount payable to the vendor, whatever amount we have to pay to the vendor, divided by issue price of shares. Means first you will be doing this workings, because until you find the number of shares, you cannot get the amount of share capital, security premium and discount. All these amounts will be available only after you find the number of shares. Without that, these amounts cannot be obtained. So how do you find that number of shares to be issued? Whatever purchase price is payable to the vendor divided by issue price of shares. Now what is this issue price of shares? If they are issued at par, then face value 10 rupees. If they are issued at premium, then issue price is face value plus premium. If they are issued at discount, then the issue price is face value minus discount. Okay, means if the shares of 10 are issued at 5 rupees premium, issue price is 15 rupees. If shares of 10 are issued at 1 rupee discount, issue price is 10 minus 1, that is 9 rupee. First this calculation will be done, number of shares will be obtained, and after that you will pass this journal entries, particularly in case of premium and discount. At par, both the amounts are same, so you can directly pass the entry even without making the workings. But at premium and discount, you won't be able to get the amount of capital and security premium, capital and discount until and unless you find number of shares. Okay, so all of you should have noted down in the summary. You can pause the video and note it again if not done. We will be taking up with question number 7, which is on page number 15 of your study material share capital pamphlet. Okay, page number 15, you have question number 7 that I will be solving. That will thoroughly cover the concept of issue of shares for consideration other than cash. Look at it. X Limited acquired from Messrs. A and Company Who is A and company? You have acquired from that company, they are the vendor, seller. So X Limited acquired from A and company machinery and goods worth rupees 88,000 and 22,000 respectively. Machinery is an asset, we will debit in our books. Goods is an asset, we will debit in our books. And creditors worth rupees 11,000, that is a liability, so we will credit in our books. Machinery we will debit with 88,000. Goods is an asset, we will debit with 22,000. Creditors are liability, so we will credit with 11,000. The amount payable on takeover of net assets of Messrs A and Company was discharged by X Limited by issuing shares of rupees 10 each. We have issued the shares at rupees 10 each. Calculate the number of shares issued. First, we will find the number of shares issued and the corresponding journal entry if number of shares issued means these workings are to be done first. If shares are issued at par, 10% premium and 10% discount. So all of you can pause the video and make the formats of it. Okay, all of you will make the format and give the heading journal entries in the books of X Limited. Okay, heading would be journal entries in the books of X Limited and make the format of one page. Okay, I guess everyone has completed the format. Let's start with the question solution. Now see, first entry to be passed is assets account debit. So here machinery and goods are the assets which we are taking up. Okay, machinery becomes our asset. Machinery comes in, debit what comes in? Machinery account debit. Now what is the value of machinery we are taking? 88,000. So machinery account debit with 88,000. Then goods comes in, debit what comes in? Goods of 22,000 are taken. So goods account debit 22,000. And to liabilities account, here the liability taken is creditors 11,000. So to creditors account 11,000. Now here to vendor account. Vendor means the seller. Here the seller is Messrs A and Company. So to Messrs A and Company account, now here no information is given about the purchase price, means we assume we have paid net assets value only. Otherwise purchase price, if you have paid more or less, would be given. So here the situation of goodwill and capital reserve doesn't arise because purchase price is not given. Simply 82,000 plus 22,000, sorry, 88,000 plus 22,000, 1,10,000 minus 11,000, 99,000. Okay. What we have to pay to Messrs A and Company is 88,000 plus 22, 1,10,000 minus liability 11,000, 99,000. Being assets and liabilities taken over. Being assets and liabilities taken over. Now, second entry for issue of shares. Here there are three situations A, B and C. So second entry will also come in three parts. First A. Now in A situations shares are issued at par. So even if you make the workings it's fine. Even if you don't make the workings it's fine. Because the number of shares won't affect your entry, it is going to remain same. So first for A point, if we make the workings, then number of shares to be issued. Okay, this formula you can write only one time. Number of shares to be issued is equal to purchase price or the amount payable to the vendor divided by issue price of shares. Okay, purchase price payable to the vendor divided by issue price of shares. Now in option A where the shares are issued at par, The purchase price is common in all the three situations, that is 99,000. Okay, the purchase price what we are going to pay to Messrs A and Company is 99,000. Now at par, first situation is at par. So here issue price would be equal to face value, that is 10 rupees. So how many shares would be issued? 9,900 shares would be given to the vendor. Okay, this workings you all will be making. So second entry would be vendor account debit, means Messrs A and Company is the receiver, debit the receiver. Messrs A and Company account debit with full amount 99,000. And since we are issuing the shares at par, so to equity share capital account, okay, to equity share capital account, as we calculated, how many shares would be issued? 9,900. So 9,900 into face value is 10. Share capital always with face value. So 99,000 rupees. As I said here, even if you would not have made the workings, it's okay. Directly Messrs and Company to A and Company to equity share capital can be recorded with 99,000. Being 9,900 shares issued at par. Now, same second entry in B option, how it will change, understand it. It's an alternative situation where shares are issued at 10% premium. Now, before we pass the entry, if the shares are issued at premium, we will have to find how many number of shares would be issued. So if they are issued at premium, purchase price stands same 99,000, but 10% premium. So issue price would become 11 rupees. 10 plus 10% premium of 10 is 1 rupee. Okay, 10% of 10 is 1 rupee. So 99,000 divided by 11. Issue price at premium becomes 11 rupees. So 9,000 shares would be issued in this situation. Until you find this number of shares, you cannot get the amounts in the journal entry. So what would be the entry in option B now? Messrs A and Company is the receiver, debit the receiver. Messrs A and Company account debit with full amount of 99,000. Shares goes out, credit what goes out to equity share capital account. But in this situation now, how many shares are issued? 9,000 shares are issued. And what is the face value of shares? Share capital you always credit with face value. So 9,000 into 10, 90,000. This is what I said to you. You cannot get these amounts until and unless you find the number of shares. So first you will have to make the workings of number of shares. Okay. Equity share capital with 9,000 into 10, 90,000, and to security premium account. Okay, to security premium account with the amount of premium. Same 9,000 shares. 10% of 10 rupee, 1 rupee is premium. So security premium will come to 9,000. You can cross check. 99,000 debit, 90,000 plus 9,000, 99,000 credit. However, before you pass this entry of premium and discount, it is very necessary to first find the number of shares. Then only you would get the amount of share capital and security premium. Okay, I hope everyone is clear with that. Now third option, the shares are issued at discount. So what would be the entry of third option? See if they are issued at discount. Again, before we pass the entry, we will have to make the workings and find the number of shares to be issued if they are issued at discount. So same purchase price 99,000, but discount now. Discount is how much? 10% again, same. So 10 rupees, 10% is 1. Now 10 minus 1 means the issue price becomes 9 rupees. So 99,000 divided by 9, 11,000 shares would be issued in this particular situation. So now if we pass the entry, say Messrs A and Company is the receiver, debit the receiver. So Messrs A and Company account debit again with full amount of 99,000, this full amount. Okay, Messrs A and Company again you'll debit with this full amount of 99,000. Now the shares are issued at discount. So discount is our loss. Debit all expenses and losses. So share discount account debit with what amount? Number of shares issued at discount 11,000 into discount amount 10 rupees, 10% 1 rupee. So 11,000. Share discount you will debit with number of shares issued 11,000 into discount amount 10% of 10 rupee 1 rupee. So 11,000. And 2, equity share capital account. Share capital always with face value. Now here 11,000 shares are issued. Face value is 10 rupees. So 1,10,000. Again you can cross check. 99,000 plus 11,000 does come to 1,10,000. Okay. So before you pass the entry, particularly of premium and discount, it is necessary that you make the workings and find number of shares. Without the number of shares, you won't get the amount of share capital, security premium and share discount. Okay. So this lecture we keep it limited to this part only. Total of journal is not required because these are 3 alternative situations. Okay. Any one situation will only arise. So total of journal need not be done. I hope everyone is clear with the entry of issue of shares for consideration other than cash, because in main questions combination will come, combined point, cash also, consideration other than cash also. So mixed questions will be coming across further. Okay. Next point of forfeiture of shares, very important point. Forfeiture of shares will be taking up in the next lecture. Okay. Bye everyone. Take care. Love you all. Bye.